Hey everyone, happy Thursday, February 8th. It's about 10:20 on the West Coast and time for another market update. Going back to last week, as I let you guys know on Thursday, on Friday, we were getting the big, important January BLS Jobs Report. And the industry was a little worried about it because, last year's January BLS Jobs Report was a killer for us, really set us in the wrong direction. And, in this specific report, the January report, the BLS does a lot of weird seasonal adjustments catching up for the whole year. And that did not go in our favor last year. So, like I said, we were a little worried. And unfortunately, it's one of those situations where I'm upset that I was correct. And it did not come in our favor. The estimate was about 180,000 jobs created. It came in almost double that at 353,000 jobs created. And they actually added, not negative, which they've been doing all year, but they actually did positive revisions to November, December's reports and added 126,000 more jobs created. So markets did not like that. Taking a closer look, like I said, 353 versus 180, that's where the markets reacted. And, that did not go well for us. But if you look at the non-seasonally adjusted number, so the non-seasonally adjusted, not doing some weird math, it came in at negative 2.635 million jobs created. So that's a big difference between 353,000 jobs created, and negative 2. That's, basically 3 million difference. So that's interesting. Let's just say that. 2-month revision, again, 117,000 added to December, 9,000 added in November. Markets did not like that. And then average hourly earnings went up, but average weekly earnings went down for year over year. And as you can see, basically we're at the lowest level outside the pandemic of average weekly hours, 34.3 down to 34.1. So that's, that equates to basically 2.4 million jobs lost since January 2023. So again, all these underlying metrics, you look at these headline numbers, but the way they get to these numbers, and if you look at the underlying details, doesn't scream the strength that, everybody's reacting to. Taking a little bit closer look, and remember there's the household survey. So not the headline, which we just looked at, but a household where the unemployment number comes from and where they actually call people. That showed negative 31,000 jobs created. So not a positive, but the total labor force also dropped off. So people, they're no longer counting in these reports. And so that's why the unemployment number stayed at 3.7. Markets were expecting that to tick up to 3.8, stayed at 3.7. You see on the news, unemployment's still super, super low. Markets react, negative for us because we know that the Fed is looking at this and saying, hey, the job market is super, super strong. We can continue to keep rates where they're at. So again, a little deeper in here, full-time work in January dropped 63,000 jobs. Now over the last 3 months, that's down 1.369 million. And then part-time work added 96,000. Last 3 months added 858,000. So again, those, people can't get, people losing full-time jobs, having to get part-time work. That does not scream strength for the American worker. But the market's reacting to the unemployment not changing, and then that headline job number popping up quite a bit. Next thing we got, so on Sunday after that, we got, Chairman Jerome Powell was on 60 Minutes on CBS and did an interview and said a lot of things we don't like, as far as, maybe we're not going to cut soon. Basically said they're not going to cut in March, even though the markets were kind of expecting that, as recent as a couple months ago, and, made it more murky when they actually will cut this year. And then throughout this last week, we haven't had a lot of news, but we've had a lot of Fed speakers basically backing that up. A lot of inflation might come back. The employment market is super strong, things like that. So all the things we don't want to hear, them having the ability to backtrack from rate cuts and going back into, hey, we're good where we're at. Initial job claims came in today at 218,000, a little bit below the estimate at 220. Again, those numbers are staying strong, backing up what the Fed's thinking as far as the employment labor market staying really strong. So we're going to have to keep a close eye on that. But again, that's usually the last thing that happens is people find for unemployment. First, job openings drop off, then there's layoffs, then there's people reduce that, all that kind of stuff. Next thing we got, so appreciation. Let's take a closer look at this. So home prices continue to go higher. CoreLogic came in negative 0.1% for December. Black Knight came in at plus 0.1. So both of those finished off 2023. CoreLogic at 5.5 and Black Knight at 5.6. So really good for homeowners there. We're still waiting for the Case-Shiller and FHFA later this month to see how those end out the year. And then CoreLogic came out with their, I think 2024, they're looking at about 2.8%. Is what they think that what they're looking for home price gains in 2024. But keep in mind, CoreLogic tends to be pretty conservative. So I think they were only this year they're about 3% and ended up at 5.5. So 2.8 would be fine, but a lot of people are thinking closer to this 5 number again in 2024. And then one thing I did hear that's not on here, but I think right now the current, the average loan holder, so not people that own their houses with outright, but people with loans have about 46% equity across the country right now. That's a huge number. Most people have a ton of equity. That's really good for people going forward. Next thing we're looking at is inventory. So I want to take a closer look at this. There's been some articles about inventory going up. So right now, existing homes, according to NAR, there's about 1 million existing homes available, across the country right now. But keep in mind, about 334,000 of those are under contract. So maybe some of those fall out of contract, but most of those aren't available for you or me to buy because they're gonna close. So active listings only about 666,000. And then so you can kind of look at this in graph form. We're actually down from about a year, or up from last month, but down from last month, but up from a year ago, but still really, really low levels. Keep in mind, again, this graph's not going back that far, but 2008, we had about 4 million existing homes available before the crash. So we're still, 666,000 actual homes available out there. That's not a lot. So we need more inventory. More inventory is not going to kill us. It's not going to make home prices drop dramatically because we're at such a dramatic loss right now as far as what we need. Next thing, so the average 30-year conventional, after the BLS Jobs Report and Fed Chair Powell and all these comments, we jumped from 6.63 to 6.97. We actually jumped above 7, and yesterday we regained some ground a little bit to drop below 7 again. But 6.97 again, testing that 6.5-ish mark, and then we've been getting bounced back up by some positive news for the the economy, but negative news for mortgage rates. So where does that leave us? As far as important dates coming up, we got CPI next Tuesday, I believe. PCE coming at the end of the month. BLS again at the beginning of March. We'll have another CPI at some point there in March before that Fed March 20th meeting, where again, a lot of people were expecting they would do their first cut at that point. But now after that BLS Jobs Report, which again threw us off track just like last year, and after Powell's comments and how the Fed's sounding, doesn't look like March is likely. But maybe, we really got to hope for the inflation numbers to come in our favor. Maybe these job numbers softened, between now and the next meeting. Maybe things change. But, definitely that January BLS Jobs Report last Friday was a killer and started us in the wrong direction. So hang in there. If anybody has any questions, don't hesitate to reach out, and I'd be more than happy to help. Have a great day, everybody.